Supply Analysis Part 4. You should know. First, supply. Supply is a microeconomic concept. Supply refers to quantity of a commodity that a seller is willing and able to offer for sale at a particular price during a certain period of time. Second, aggregate supply. It is a macroeconomic concept. It refers to the minimum amount of sales proceeds which entrepreneur expect to receive from the sale of output at a given level of employment. Concepts of cost and revenue. A. Cost concepts. When an entrepreneur undertakes an act of production, he has to use various inputs like raw material, labor, capital, etc. He has to make payments for such inputs. The expenditure incurred on these inputs is known as the cost of production. Cost of production increases with an increase in need of output. There are three types of cost which are as follows. First, total cost, TC. Total cost is the total expenditure incurred by a firm on the factors of production required for the production of goods and services. Total cost is the sum of total fixed cost and total variable cost at various levels of output. TC is equal to TFC plus TVC. TC is equal to total cost, TFC is equal to total fixed cost, and TVC is equal to total variable cost. Total fixed cost, TFC. Total fixed costs are those expenses of production which are incurred on fixed factors such as land, machinery, etc. Total variable cost, TVC. Total variable costs are those expenses of production which are incurred on variable factors such as labor, raw material, power, fuel, etc. Second, average cost, AC. Average cost refers to cost of production per unit. It is calculated by dividing total cost by total quantity of production. AC is equal to TC by TQ. AC is equal to average cost, TC is equal to total cost, and TQ is equal to total quantity. For example, if the total cost of production of 40 units of commodity is rupees 800, then the average cost is AC is equal to TC by TQ, which is 800 by 40, which gives the answer is rupees 20 per unit. Third, marginal cost, MC. Marginal cost is the net addition made to total cost by producing one more unit of output. MCN is equal to TCN minus TCN minus 1. Here n is number of units produced. MCN is marginal cost of the nth unit. TCN is total cost of nth unit, and TCN minus 1 is total cost of previous unit. If previous total cost of producing 4 units is rupees 200 and total cost of producing 5 units is rupees 250, then MCN is equal to TCN minus TCN minus 1, which is 250 minus 200 rupees, which gives the answer rupees 50. B. Revenue concepts. The term revenue refers to the receipts obtained by a firm from the sale of certain quantities of a commodity at given price in the market. The concept of revenue relates to total revenue, average revenue, and marginal revenue. First, total revenue, TR. Total revenue is the total sales proceeds of a firm by selling a commodity at a given price. It is the total income of a firm. Total revenue is calculated as follows. Total revenue is equal to price into quantity. For example, if a firm sells 15 units of a commodity at rupees 200 per unit, TR is calculated as TR is equal to P into Q, which is rupees 200 into 15, which gives the answer rupees 3000. Second, average revenue. Average revenue is the revenue per unit of output sold. It is obtained by dividing the total revenue by the number of units sold. AR is equal to TR by TQ, where AR is average revenue, TR is total revenue, and TQ is total quantity. For example, if the total revenue of 15 units is rupees 3000, then average revenue is calculated as AR is equal to TR by TQ, which is rupees 3000 by rupees 15, which gives the answer rupees 200. Third, marginal revenue. Marginal revenue is the net addition made to total revenue by selling an extra unit of the commodity. Here, MRN is equal to TRN minus TRN minus 1. MRN is marginal revenue of nth unit. TRN is total revenue of nth unit. TRN minus 1 is equal to total revenue of previous units. N is equal to number of units sold. For example, if the previous total revenue from the sale of 20 tables is rupees 4000 and that from the sale of 21 tables is rupees 4200, marginal revenues is calculated as MRN is equal to TRN minus TRN minus 1 is equal to 4200 minus 4000, which gives the answer rupees 200 per table. Find out if a firm sells 400 units of a commodity at rupees 10, calculate the AR and TR